Hey guys, Marcus here. As we're going through November and December, working with clients, talking with prospective clients, and one big thing I see with a lot of people is they don't do tax planning. So I'm going to give you a quick tax planning tip and something we use here at Mirror Group CPAs with our clients. Just one of the tools kind of in the tool belt, so to speak, of tax planning. And this is something I always talk about, which is tax planning comes on the heels of a good foundation, right? Of good bookkeeping, being organized, all that kind of stuff. Nothing that's sexy, but everything that pays off in the long run if you practice those good habits. So today's tip is donating appreciated stock. Okay, so let's talk a little bit about that, right? We've got a lot of things going on here. We've got stock, we've got charitable, we've got capital gains, all that kind of stuff. So what am I talking about exactly? Let's give you a scenario. Let's say you bought a stock for $20,000, like that's your basis. And that stock has increased in value to $100,000. So think of like your Nvidias or your stocks that have really run up. You might have a stock that you bought for $20,000 that's worth $100,000. Let's take a little step back and let's also say would be something in a taxable brokerage account, like not something in your 401k or your IRA or simple IRA, SEP, something like that, but in your taxable brokerage account. Think your TD Ameritrade or Schwab or Fidelity, something like that. Okay, so if you take that 100 grand of stock and you donate it to charity, well, you get a $100,000 tax deduction. So most people would be thinking, how can I get that? Well, when you donate to charity, you get to donate the value of what you gave. But here's the kicker. On the $100,000, you had an $80,000 unrealized gain, right? The $100,000 value minus the $20,000 cost. That $80,000, if you'd have just taken the stock, sold it for 100 grand, you would have paid capital gains taxes on that 80 grand, and then you would have the remainder of the money left over to give to charity. So what have you done when you do this? Well, you get a higher amount you give to charity, but two, you avoid the capital gain. Now here's where the planning comes in. Let's say you were wanting to be really charitable, or you wanted to do charitable better. Well, there's a bunching strategy. There's a strategy where you give your donations to a donor advised fund, and then you let that fund dole out your charitable contributions over the years. Well, a good way to do that would be with a highly appreciated stock and not with cash. So if you're looking for year-end ways to save money on taxes and meet some charitable goals and really do planning well, this is something that really threads that needle, so to speak. So give it away, get the fair market value deduction, miss the taxes on it, which is always great, and then be able to give more than you otherwise would if you simply sold the stock, pay the taxes, and then gave the after-tax proceeds. So that's today's tip. We'll be trying to do one of these again shortly here, maybe early next week. So if you got a question or a comment, drop it below. I'd love to answer that. Chances are you've got a question that other people have, so it'd be helpful to answer, or a suggestion for a future video. I'd love to have that. Maybe take you up on it. All right, guys, we'll see you on the next one.